So we're going to start with the real estate part. So when you're looking at real estate investments and all, what is the objective of investing into real estate? One, diversification, very important. And second, inflation hedge, both very important objectives. Inflation hedge, although, is going to be better suited for commodity. So let me explain this part first, then I'll explain, because you'll have to be very careful when you're attempting questions. It's very important, all those things that I've told you, mistakes sheet, strict sheet, etc. in that how to study and practice lecture, very important that you people follow all those instructions. And be very careful, because you need your accuracy rate has to be very important. You understood all that. I've informed you of all of those things for the exam. So now when you're looking at the real estate part, so normally how do you earn return from real estate investment? One component is rental income and the second component is price appreciation. You're buying a flat, you're buying a shop, you're buying a office property, you're investing whatever kind of real estate investment. There is going to be one component which is a bond-like investment return. Your rental income is kind of a very stable, stagnant, stable, fixed kind of a cash flow. Over a shorter term at least, then your rental might get increased, your rental might get revised. So one component is around a bond-like characteristic where you have your, you're getting a rental income where you're getting a fixed income kind of an income. The second component is the price appreciation, one of the most important components when you're looking at the real estate investment. So when I'm looking at real estate, price appreciation is like an equity-like part where we're looking at growth, where we're looking at long-term increase in prices, right? Now, so what is the reason why we would want to invest into real estate? One is diversification, because the correlation of real estate would be rather low with equity bond with traditional investments, so that in totality my Sharpe ratio goes up. Sharpe ratio, separate lecture I've told you, because that's the most important objective over here is to be able to Sharpe ratio. I think brief में मैंने बताया था. I think I told you in very short manner in one of the lectures. Altaiga ki some other lecture, some other class I told you. The idea is that we want to maximize return per unit risk. So even if there is diversification, even if my total risk goes down, my return per unit risk might go up. Anyways, I'm assuming your covariance, correlation, you've understood, and all of those things are done. So diversification, inflation hedge becomes important. So how does inflation hedge help over here? Because as inflation levels increase, your rental income will increase, because if inflation is high, the rent also increases and property prices would also increase. If there is inflation, if the price of steel, cement, etc. goes up, then the price of construction goes up, the price of the property prices also go up. But if I get a question where which of the investments you would want to do for hedging against inflation, real estate, in commodity, something else, the answer will be commodity and not real estate, because commodity does a better job at inflation hedge, because inflation itself is, what does inflation mean? Inflation is the increase in price of commodities and the basket of goods and services, right? So if the commodities are going to be the best inflation hedge that way if you look at it. So even though real estate does work as an inflation hedge, it is offering you inflation hedge, but commodities will do an even better job at inflation hedge. Commodities do not provide you regular cash flow. You do not get a rent from owning a commodity. Tell me, are you following this? So the idea is diversification and inflation hedge. Now when we're looking at the different ways of classifying real estate, you can look at it from again 2-3 perspectives. One, you could be looking at real estate investment from a direct or indirect method. So if I own a flat, a property, that is direct investment. If I own a real estate investment trust, real estate ka mutual fund, I've briefed you on that, then in that case that becomes a indirect investment, because I'm investing into the REIT, and REIT is pooling in huge amounts of money and investing into real estate properties and generating rental income and all. Tell me, comfortable? So one way of looking at it could be direct and indirect. One way of looking at it could be equity or debt. So say for example, I'm buying real estate. I'm owning the property. That is equity investment. Say for example, I am investing into bonds. So we people, when we buy homes, we take home loans. What bank does is, it pools those home loans together and issues bonds against those home loans. This is an entire chapter altogether, mortgage-backed securities, which I will not cover right now. So the NDS related portion you will study only after mortgage-backed securities is covered. For right now, just understand, let's say HDFC Bank is there. HDFC Bank has given thousands of home loans to people. Now, HDFC Bank puts together all those home loans, and HDFC Bank also needs to raise money. So against those home loans, it securitizes it, it separates those home loans and issues bonds against it. I can invest in those bonds. There are people who want to invest in equity. There are people who want to invest in debt. Ultimately, what happens? We people only put our money in the bank loans it out. Ultimately, it's we people only who put the money in the banks, right? Banks are acting as nothing but an intermediary. Tell me, are you following this? So one way of investment into house or into real estate is owning the property. One way of investing could be owning bonds, which have been used to give loans to these home loans and property loans and all of that. So I can have a debt investment into real estate where I'm sponsoring loans. Say for example, I personally give you a home loan. That you buy this house, I will give you a home loan. Are you understanding the idea? LIC Housing Finance. There are companies who specialize into housing loans, etc. So real estate loans. Suppose I've given you a home loan. Ultimately, I have invested into the debt of the property. I am investing into the debt side of the property, and if you're looking at equity, in that case, I'm owning the property, the equity side. So one is a direct and indirect investment. One could be a debt equity kind of an investment. One could be based on the kind of investment you're doing. So first we'll see whether you're making a residential investment, a commercial investment, or you're making an investment in the form of loans. So when I'm looking at residential, commercial, understands the demarcation is very simple. If you are buying a house to stay, it is a residential investment. If I am buying a house in which you will stay and I am renting out that house to you, that is a commercial investment from my point of view. And it is not an investment from your point of view because you are renting it out, you're not owning the property. It's not an investment from you, from your perspective. The house I stay in is my residential property. The house, even a flat, even a residential flat, if I have bought and rented it out to somebody, that is going to be classified under commercial property. From my perspective, it's commercial property. And from the tenant's perspective, it's not his property altogether. Tell me, are you understanding? So when I'm looking at residential property, it's a direct investment. Generally, the house you stay in, that is going to be your residential investment. Maybe leveraged. If you've taken a home loan, that means it's a leveraged investment. If I'm buying the property with entirely 100% my funds, then that is a 100% equity investment. There is no leverage. There is no loan amount. But most of the cases we'll be taking a home loan because one, the price of the house, the cost of the house is quite bulky. And second, the home loan rates are also very cheap. We get tax advantage, tax incentives also, savings on interest cost and all. So in fact, even if 3 people take a home loan, they can buy a joint house and they can take a joint home loan. So if say for example, you have 3 members in the family, you should, all the 3 should buy the property in all the 3 names. They can take 3 individual home loans and each of them will get a tax deduction separately for the interest and all. So you have to do these kind of tax planning because if I'm getting a loan at 6.5-7% or so, 6.8, 6.9%, and I'm getting a 30% tax deduction, your effective cost of interest comes down quite a bit. Tell me, are you understanding this? So maybe leveraged, may not be leveraged. If you take a home loan and buy, it's a leveraged investment. Lender is going to be the bank. You are the owner of the property. Think from a bank's perspective only. Bank has given you a home loan. Bank has made a direct investment into the loan. Bank made a direct investment in loan. Tell me, are you following this? Now, why do we say direct investment in loan backed by a mortgage? What happens? If say for example, you default on your home loan, the bank will be able to take the house. It will be able to sell the house in the market. Whatever money it will get from the house, it will keep, and whatever extra money it has received, if it receives any extra, will go to you. Similarly, this is how it happens. Understand, it's very important to know why direct loan investment into real estate is separate from regular loans of a bank. Say for example, a bank loans out X amount of money to a company, Kingfisher, let's say. Now if it is not able to recover, if the company Kingfisher defaults, can it sell a house? No, it can sell Kingfisher's assets. Uska calendar बेच के कुछ नहीं मिलने वाला. So what is going to be the recovery when you're selling a Kingfisher, when you're selling the aircrafts and all? So what is the loan backed by? It is backed by those aircrafts and the assets of that particular company. Right? Earlier it used to be so difficult to recover dues. It used to be all under the table nonsense. Now at least they're being able to recover dues. Even now it's really bad with the loans and with how the PSUs are writing off loans and all. It's quite a bad state. If you look at a very good level, people are taking loans where they don't deserve and they're defaulting on loans. They've siphoned away most of the money. So anyways, but you're understanding the bank is directly, when a bank is giving a home loan, The loan is not backed by those Kingfisher flights and all. It is backed by a house. The home loan rates are low because the bank, actually if you take a home loan, your property papers will never be with you. The original papers will be held by the bank till the time you have paid the entire home loan. So now the bank owns the property. Owns the mortgage on the property. So if you don't make the payment, then the bank has a right to pay off the home loan, to sell off the house and recover the dues. There is less risk because normally we would assume that the real estate prices will continue to increase or will at least not fall down. Normally, fall down we generally do not see. Tell me, are you following this? But that happened in 2008 because the entire thing was misused. That is a separate topic and lecture and this thing altogether. Asset securitization and all. That lecture is also there on YouTube. Tell me, are you understanding the lender's perspective and why it is important to understand a loan when you're giving a loan to a company and when you're giving a loan to a corporate? It's two different things. Why are the home loan rates cheaper? Credit card loan if you take or a personal loan if you take, it's going to be way more expensive. You're understanding the idea? And the person who's owning the house, he has made an equity investment. He's owning the house. If say for example, you bought a 50 lakh rupees house and you've got a loan of 40 lakh rupees. If the house price becomes 55 lakh, your ownership is now 55 minus 40. 15 lakh rupees is your ownership. You buy a 50 lakh rupees home. You've taken a loan of 40. What is your stake in it? 50 minus 40, 10 is yours. If you sell the house, you will pay 40 lakh rupees home loan amount and the remaining 10 is extra is with you. If the house becomes 55 lakh, you will sell at 55. 55 minus 40, 15 is yours. The extra 5 lakh does not go to the bank. But if the price decreases to 45 lakh rupees, even then that 5 lakh rupees is your loss. You sell the house at 45, pay off a loan at 40 and you're left with 5 lakh rupees only. And what happened in US was that the prices of homes went down below 40. And now what I'll do? Take the keys, you sell the home yourself. Because if the house is below 40, even if I sell it at 35, I'm not going to give you 5 lakh rupees extra because the bank has only the right on the house. When it's a mortgage loan, the bank does not have right to your other personal jewelry, mutual fund, shares, etc. Nothing. The bank can only touch the house. So the house property prices went down significantly. Anyways, that's a different lecture. You'll have to do that in order to get very comfortable with just this part. The MBS term, mortgage-backed securities, etc. You'll have to study that separately. MBS itself will take me an hour and a half to teach.
So MBS is indirect.
Mortgage-backed securities. MBS will become indirect. When a bank is giving loan, it's a direct debt investment. MBS is indirect. So, MBS is indirect loan investment, correct. You'll have to study MBS separately. But this is your residential. When I'm looking at the commercial, that is, it is going to generate rental income. There are different ways, different kinds of rental income you can generate. It could be an office building, it could be a shop, mall, anything at all. It could be a residential home also. If it is rented out, it is classified as commercial property. So whenever you're generating rental income, it is commercial property, simple. It may be leveraged again. And real estate, given that the size, the bulky investment it is generally leveraged. It is long-term in nature. Obviously, you do not buy a house today and sell tomorrow. You do not buy an office space, rent it out today and sell it tomorrow. So it is a long-term investment. It's a large size investment until unless it's an REIT kind of an investment you're making, where it is real estate, mutual fund kind, small amounts of money you're investing, and it is also illiquid. You've discussed this real estate. Liquidity is the ability to convert an asset into cash at its fair price in a short duration. You will never ever say the short an incomplete definition. Never ever say an incomplete definition of liquidity, right? Real estate is going to be illiquid, and because of these things, retail investors would find it very difficult, and it is only for large wealthy investors who would be able to get into the space. Owning your house is separate. I'm talking about renting out properties and all. I'm remembering that episode. Charlie Sheen's girlfriend turns out to be a landlord, and that episode, do you guys remember? What was the name? I'm forgetting. 2.5 Men? Nahi dekha. What do you people do? Don't read books, don't watch nonsense, comedy, detective. Huh? Don't even study CFA properly. Don't give me all that. That we people are just studying all the time. These properties also, what happens is that you may not own these properties directly, but through pooled investment vehicles. You can have an LLP, limited liability partnership, which might be managing it, or you might be owning REIT. So you can have direct forms of investments. You can have indirect forms of investment into real estate property, into commercial property. REIT I've already discussed, mutual fund of real estate, small amounts of money, we people invest, hundreds and hundreds of crores is accumulated, professionally managed, they invest into rent generating office spaces, IT parks, malls, hotels, whatever. We've done this. This is indirect investment. In REIT, there would be thousands of lakhs of people investing together, very small amounts of money. In a limited liability partnership, you can have maybe 10, 15, 20 people pooling relatively larger amounts of money, but the benefit will be diversification. Instead of me owning one office space, I can pool, and let's say I'll invest 1 crore rupees. I can have 15 people put 15 crore rupees and they might own a warehouse or something together. You're understanding? Relatively larger size investors, and there will be a diversification benefit here. Because in an LLP, when you're pooling in at least a good chunk of money, you'll be able to rent it out, you'll be able to diversify across multiple properties. So here there could be lakhs of people, but in an LLP it could be in 20s, dozens or something. Tell me, comfortable? Again, loans, when a bank is giving loans and all, whole loans, property loans, whatever, whole loans, as in I am giving the loan. I am not contributing 1 lakh rupees bond and then, that is being pooled in together and all. I am the one who's giving the whole loan. It's a direct investment through commercial mortgage-backed securities. It is indirect investment. Actually, I mentioned this over here. I wrote it again over here. Mortgage-backed securities in MBS chapter. No details over here. Okay? So when bank is giving out loan, that is direct investment, whole loans. When the bank is issuing bonds against those loans, that is commercial mortgage-backed securities, residential mortgage-backed securities. These are indirect debt investments. Obviously, these are debt investments. These are debt investments. When you're investing into the loan side, you're investing into the debt of real estate, debt side of real estate. Next, when we're looking at real estate investment trust, it simply trades like shares on the market. One of the first in India was Embassy Parks. Go check the share price. I had invested a very small amount of money just to check and track the price. I think it was at 260 or something I had invested. I don't know what's the price right now. Check karna. Do this homework. Download Embassy Parks equity research report on a trend line website or something. Download a report, a sample report, see what the company is doing, read the abstract of the report first. It will give you a kind of a summary of what the company is doing and everything, what kind of property it owns. Look at the asset value and the rental income. At least get an understanding that, okay, this is the value of property these people own and this is the amount of rental income they generate. Get basic understanding. 362. 362. I bought a 260 or 360. I bought a 260, 280 type only, I think. I'll have to check.
REIT.
These are REIT. Embassy Parks is a real estate investment trust.
Embassy Office Parks REIT.
Embassy Parks is an REIT. It trades exactly like shares. So you can buy and sell throughout 9 to 3:30 and you can see live prices in the market. Check. Good. I'm glad to see this. Now there could be different kinds of REIT depending on what is the REIT investing into. Is it investing into mortgages? So there could be an REIT. See, first of all, REIT is indirect investment. An REIT could be investing into mortgages, loans. So this becomes indirect debt investment. REIT could be investing into hotel properties, malls, commercial office spaces, etc. These would be indirect equity investment into real estate. And please don't get confused. Don't mug up all this. Yeah, direct means I'm buying the property, owning the property directly. Indirect means I'm going to be investing through a pooled vehicle or something. Correct? Debt means I'm investing into the loan side, the debt side. Equity means I'm investing into the ownership side. That's it. It's so easy. Now REITs have certain regulations and all. REITs, normally what happens is, normally what happens is if a company, let's say a company is earning 100 rupees before taxes. Let's say the company's income, not revenue, income before taxes 100. it pays 30% tax, let's say. It is left with 70. Suppose this entire 70 is given to you as dividend. You will again have to pay taxes on this. I'm assuming your tax rate is 30%. You again pay 30%. There is a double taxation that is happening over here. In real estate investments, you cannot have this kind of double taxation. It becomes very problematic. The government also wants real estate infrastructure to boost, right? Economic growth and all of that. So what the government says is, suppose REIT is earned 100 rupees in rental income. The government says that you will not have to pay any taxes provided you distribute 90% of your income. Then only the investor will obviously pay taxes. So I'm left with 70, here you're left with 59. 49. 49 now. Tell me, are you understanding? The government basically generally comes up with regulation that REITs will not have to pay taxes provided they distribute 90% of their income as dividend. They don't reinvest. And second, most of their income, there will be rules and all. You don't need to know the rules exactly, and it will differ from country to country. And second is that their majority of their income is going to come from rental income, so that the investment into real estate and all increases. So that is why an REIT would most often want to distribute their incomes away, their rental income away, so that there is no double taxation impact. Tell me, are you following this?
So only if the income is from rental?
Income has to be majority. There are clauses and all. We don't know the regulations because it will differ from country to country, but majority of the income has to be from rental income. Majority of income has to be from rental income and all. Tell me, comfortable? So REITs will pay maximum dividend. So now what does it tell you from an investor's perspective? An investor would have to understand that this is more of a growth kind of a stock or a dividend. You have those schemes, mutual fund dividend schemes and growth scheme and all. This is going to work more like a dividend. This is going to give you more of a current income. I did not invest with a current income perspective, but I wanted to invest and gain a little exposure into real estate. And direct ka paisa nahi hai, so you have to invest through indirect. You're understanding? So when you're investing into REIT, you have to understand that it is going to be giving you a lot of current income. So what is your tax bracket? If you're in the highest tax bracket, you will be charged. You'll have to pay taxes at the highest possible rate over here, at the higher marginal tax rate. Tell me, are you following this? And when you're looking at REIT, there also could be price appreciation because of the value of property. There is a major problem with REIT. The problem with REIT is, that I'll come later. There is a major problem with REIT, that is REIT is highly correlated with equity market. Because REIT, see, understand, when the market is panicking, economy is not doing well, we end up selling shares. Share prices go down because people again revise their expectations. They're not very hopeful about the economy, markets, etc. And it is possible that people are not willing to buy those shares at higher prices. Even if you're not selling, it is possible that people are not willing to buy stocks at high prices. The prices immediately reflect. The pessimism, the economic condition reflects in the prices immediately. That is because equity is also trading throughout the day 9 to 3:30. Tell me, are you following this? So equity market reacts. But the moment the economy is bad, 2008, 2020, things are not going well, do you start selling the house or properties or whatever you had invested into? No. But will you be able to do that with REIT? Will that get reflected in REIT? Yes. If you had an office space which you had rented out, you might have shut it down, but you would not have sold just because a COVID period is happening. But expecting that because REIT has invested into office properties and people are moving to work from home, TCS has announced this, Infosys has done that, I am very pessimistic about it. Let me sell all my REIT shares. Why? Because I can immediately sell it and get money. Because it is liquid. REIT starts behaving more like equity. It is trading like equity. It's highly liquid. It starts reacting the way business cycles are, the way the business cycles are moving. REIT starts behaving that way. Correlation of REIT with equity is very high, but correlation of real estate, individual, direct real estate with equity is very low. We were investing into real estate assuming that we are going to get good diversification benefits. Correlation of real estate would be lower with traditional forms of investment like equity and bond. But when you invest in real estate through REIT, you don't get the desired diversification benefit. because REIT's correlation with equity is higher because it trades much like equity. But real estate's correlation with equity is lower. But again, the problem is in direct real estate, you don't get diversification geographically. If I'm investing in REIT, I own properties across the country. But if I want to directly invest into real estate, I won't even own properties across the city. I will own one property, one flat in one some gully. Are you understanding this? So of course there are advantages and disadvantages. I get diversification in terms of geography, in terms of properties and all of that. But my diversification with respect to my other asset classes, equity, bond and all, that goes bad. With equity goes down. My diversification goes down. My correlation goes up. Correlation goes up. Diversification goes down. Tell me, are you following this? Correlation of REIT and bond is low, but with equity it's high because REIT is anyways behaving like equity. But real estate ka correlation with equity is low. So you have to understand how are you looking at your diversification benefit while investing into real estate through REIT. Tell me, comfortable? Getting the idea? So you have to be very careful. And again, I had started with the alternate investment part stating that different asset classes within the alternate investments are also very diverse, heterogeneous. Within real estate also you have direct, indirect, you have debt and equity side, you have REIT or direct. So you're understanding how much of heterogeneity, how much of different characteristics these investments will have. Very interesting, and that is the reason why we needed specialized managers. We had discussed, and that is why the difference between the top and the bottom quartile managers is very high. Inefficiency in the market is there. Alpha can be generated, good returns can be generated by having specialized knowledge, by being able to capitalize on this. Tell me, comfortable till here? This is a very important part. So when you're looking at indices, what is indices? When you're looking at Nifty, that index tells you how the Indian market has been performing. So we look at the Nifty index and we see how Indian markets are doing in all. Sensex, sorry, Nasdaq, S&P, Nikkei, indices across the world, in order to see how that country or how the equity and stocks and all of that country are doing. You can have pharma index, banking nifty. Bank nifty basically tells you how the banking stocks are performing in India, right? So you need indices to give a representation of how that particular asset class is doing, how that country is doing. We use indices, a group of stocks, a group of investments together, how they have been moving over time, how they have been performing over time. Similarly, I also want to know indices. I want to calculate indices of real estate because I want to see how the real estate market is doing, how the real estate sector is doing. I want to see the indices. I want to compare real estate index ka movement with Nifty's movement. I want to see whether real estate has outperformed Nifty or Nifty has outperformed real estate in the long term. Tell me, following this? So I want to see these. I want to see these indices in order to understand how the sector is performing. How do you calculate the index in case of an in case of real estate? So there are three kinds of indices we are looking at. REIT is very simple. Right now we have 2 or 3 REITs in the country. 2 I know, 3, I'll have to check. So we have these REITs in the country. Obviously, even Embassy Parks, I don't think it's more than 5 years old. I think it's 3-4 years old if I'm not wrong. So when I'm looking at these REITs, we have very less number of REITs. Say for example, you're looking at US market where there are, let's say 10, 20, 15 REITs available, a developed market. All you can simply do is you group all the 10-15 REITs together and you calculate how the total of those REITs are moving, how that group of REITs is behaving. So you can simply get an REIT index. How do you calculate Nifty? There is another reading on how to calculate indices and all. But equity index, what do? You put together all the 50 stocks and you get your Nifty, you get your index, how the group of 50 stocks are performing. You put together 10, 15, 20 banking stocks and you get your bank Nifty, how the banking sector is performing. You put together 10, 15 REIT prices and you get your REIT index. You get an idea as to how the real estate is moving. But real estate is going to be more reactive because REIT behaves more like an equity. Actually, say for example, in 2020, when the markets plummeted in March 2020 or April 2020, at that time, REIT index would have shown that the real estate prices have gone down. But actually, do you think that many sale or that many properties were being sold at such low prices in the market? It's not that there is a lockdown and tomorrow people start selling their offices. So REIT is not truly reflective of what the real estate prices are. It is more reactive, it is behaving more equity-like. But that's a very easy way of calculating index, constructing an index. because I've got the live market prices. Because REITs are trading like shares, I've got the live market prices of REITs. Tell me, following this? So I can just group together REITs prices, and that is trading like I've got my index value. Tell me, comfortable? Clear? Now, there are two other indices. One is an appraisal based index. Now, REIT may not be giving you a very good coverage, because an REIT could be owning more of commercial properties or rent generating properties, may not be giving me a good idea about the residential properties and how they are moving. So REITs may not be very helpful in order to understand on a very broader level as to how the real estate market is doing. One of the indices calculation is appraisal based index. What is an appraisal based index? So there are a lot of government data. So even we have your Central Statistical Institute and all is there. You've got there are different government bodies who are responsible for publishing data, industrial production data, inflation data, etc. So there are a lot of government bodies which are responsible, population data, etc. So government collects a lot of data and they are responsible for publishing these. So there are organizations like there is one National Council of Real Estate Investment, NCREIF, if I am remembering it correctly. Investment fiduciaries, correct, fiduciaries, sorry. So NCREIF, National Council of Real Estate Investment Fiduciaries and all. So when you have these kind of bodies which are supposed to be councils and all, which are supposed to be publishing data. How do they publish data? They're basically going to go for an appraisal method. What is an appraisal method? So say for example, 2 lanes behind this, just beside this Lalit Great Eastern Hotel, there is a Lalit Great Eastern Hotel was sold to some buyer. I can get an idea as to what was the square foot price, etc. that was charged. It will be a little difficult. Let's say an office building was sold. So what was the square feet price? What is the price over here? What was the square foot price over here? What is the area of this office? Is there a lift? Yes. Is there parking? Yes, but not for outsiders. Visitors parking is not available. So I'll compare this property and that property. If that property has shown an increase of 20%, that property sold at a 20% appreciation or something, I can appraise the value of this property. This property is not being sold. But based on similar property being sold around me, I can appraise the value of this property. I can calculate, we can have those real estate valuers and all are there. They can do the calculation for the value of the property. So appraisals take place. Quarterly, annually, semi-annually. Normally quarterly appraisals take place or semi-annual appraisals take place depending on how the index is calculated. So these appraisals will happen, and based on these appraisals I can calculate the index value. The appraisals will tell me how the property prices are increasing. So based on the appraisals I'm going to be publishing this data. What is the problem with this appraisal? One is that it is lagging. What do you understand by lagging? After that property was sold at a higher price, then I appraise this property at a higher value. Property price बढ़ चुका है, then you are waking up that okay, prices have increased. So appraisals are lagging, not leading. Appraisals take place after the property prices have actually already increased. Property prices have actually already increased, then appraisal is taking place. It is lagging, the indicator is lagging, the index is lagging. It shows you higher value after increase has already happened. And that is also not a daily basis like REIT index, so you can see daily because you have daily prices available. But this is happening maybe on a quarterly basis. You don't have daily prices of real estate. Tell me, are you following this? So one is periodic appraisal. It is not even you don't even get prices and index values and all on a daily basis. This is a periodic appraisal. It is lagging in nature. Second, also what happens is, see, when you're doing appraisal, in reality, the prices, maybe the real estate market is like this and suddenly there is a boom. Then maybe the market is going this way. But what the appraisal part is going to do, the appraisals are going to take it this way. Because appraisals are happening on a quarterly basis, but it is not necessary that your property prices will be changing or increasing on a quarterly basis. So instead of a sudden jump, appraisal is going to try to smoothen the entire thing out. Because on a regular basis they'll be gradually showing the increase or decrease or whatever is happening in the property prices. They are smoothening it. Tell me, are you following it? They are showing a consistent increase instead of the real market scenario. Because in the real market situation, it is possible that the market is in a very lull kind of a phase, which it was, I think, when you're looking at before 2019 period. The markets have actually picked up 2020, 21, 22 time, at least the real estate market when you look at it. right? When you're looking at this, they have smoothened the returns and all. They have smoothened the data. Instead of showing those abrupt jumps, appraisals on a quarterly basis, they have made the entire thing gradual. So instead of showing abrupt movement, which is the reality is that abrupt movement, I have smoothened the change. I have understated my standard deviation and my correlation. I have understated my standard deviation and correlation. Because when I calculate standard deviation for this kind of data and when I calculate the standard deviation for this kind of data, obviously this data will be showing a lower standard deviation, lower correlation. I have understated sigma and correlation compared to what it should be. The actual movement is not smooth. You have done the appraisal in order to make it smooth. Not in order to, but your appraisal has inadvertently made the data smooth. Your sigma and correlation is understated because of this index calculation. Abhi is index ke bharose when you do investment, when you make investments assuming this correlation, based on this correlation and standard deviation, don't you think you are underestimating risk? You think you've taken this level of risk, but the actual risk is higher. If I understate risk, I might end up over investing in this asset class because I thought that this is a less risky investment opportunity, so let me put more money into it. It's a problem. You are underestimating risk, so therefore you might end up over investing in this sector. You should not have, because you also have a level of risk that you can take, right? You have a risk budget, that this is the amount of risk I can take. You incorrectly understated the risk. The risk was more than what you calculated. You assumed, you thought that I'm going to get a lot of diversification benefit, equity real estate is going to behave this way. They did not, because you undercalculated, you understated your correlation. You understated correlation. Tell me, following this.
Can you explain the correlation part?
Correlation also is going to get understated when you're smoothing the data. Otherwise, the correlation also would have been more random, because when you're looking at equity prices changing and when this is moving this way, so when there is more gap between x and y, x minus x bar, y minus y bar, if it is moving in a more random fashion and when you have more abrupt changes, correlation is also going to be stated lower, is going to be higher. But you smoothened the data and you have understated correlation. You have used smooth data, because if I'm using this index value to calculate SD's correlation and everything, standard deviation, correlation, everything, that will be understated. And my decisions based on that will also be incorrect. I will overstate diversification. I'll assume that I'll be getting a lot of diversification benefit, but I did not. Tell me, following this problem. Bolo? Sure. And next is repeat sales index. Repeat sales index, the name says it all. Repeat sales. So basically, in order to find out the return, in order to calculate the return from a property, I need a cost price and I need a selling price. How do I get two prices? If a property is sold once, I just have one price, P1. If a property is the same property is sold second time, then I get a P2 minus P1 by P0, selling price minus cost price by cost price, original price. So I need two prices. That is why it is repeat sales index. I need the sale of the same property to happen twice, a property which is sold twice. Then I have a buying price, closing price. Tell me, are you following? And obviously those properties which are sold more often will be a part of my index. Don't you think that this is a biased sampling method? Because you are not, your index includes only those real estate properties which are sold multiple times. Your index does not, say for example, I lived in my flat for 30 years. That is not going to be a part of this index, but I want to, what is the job of an index? To represent what is happening in the real estate market and how the changes are happening in the real estate market. That is what the job of an index is, right? Tell me, comfortable? But in repeat sales index, because of your method of calculation, you have a sample selection bias. Your bias is to include only those properties in the index which have been sold multiple times and not include those properties which have not been sold multiple times. Tell me, comfortable? Okay. So repeat sales index is based on actual market prices, actual selling prices of the properties that have been sold at least twice. If a property is sold twice, 2020 a property is bought, somebody sold, obviously. So I have one price now. 2021 again, that property was bought and sold by somebody. Now I have two prices and I can calculate the appreciation in that year. So I need the property prices at least twice and I need that sale to happen at least twice. But which properties are included? The property that was being owned by somebody for 20 years, 15 years or whatever, that is not being owned over here, that is not being calculated or considered over here. Only those properties that have been sold multiple times is being included. And tell me which kind of properties are sold multiple times. The one that is appreciating, people want to book profits, people want to book their income, their positions. So don't you see that your index is biased upwards? Because you're including only those properties which are sold multiple times, and generally those properties are sold multiple times where there is a lot of price appreciation happening. People want to take out their money, they want to book their profits. So your calculation is upward biased. So if I look at this index, which is calculated using repeat sales method, I will be overestimating the returns of real estate and I'll be so excited, okay, let's invest in real estate, it is giving me this kind of return. But reality is not going to be that way. You'll be disappointed with underperforming real estate investment. So we need to know that how the indices are calculated. Looking at this index, please don't say that, okay, I'm going to be, the real estate market is going to be reacting so quickly. Looking at this index, you will be inclined to underestimate risk and correlation. Seeing this index, you will overestimate returns of real estate segment, jabki it is not going to give you that kind of return. Although it will not give you that kind of return. Are you understanding this? So repeat sales index is based on actual market prices. That's also an advantage because this is based not on actual data. This is based on appraised data. Month-se data, whatever you are thinking, you are calculating, and lagging data. Lagging, but this is based on market prices. But the problem is the sample is biased. There is a sample selection bias where the sample is biased towards those properties which have been sold multiple times and the returns will be kind of overstated over here. Tell me, are you understanding this till here? Alright, I think last part for real estate. So when you're looking at the property prices, there's more of common sense. What are the factors affecting property prices? Economic conditions. If the country is doing very well, property prices would increase because there'll be more people buying homes, demand will increase, prices will increase. Commercial space, even more important. If there is more business activity, there is more offices, warehouses, etc. Because of the flourishing e-commerce, there is so much of demand for warehousing and storage facilities and all required. Because of COVID, vaccines and all requirement. I saw the Snowman Logistics, there's a share, the prices had increased. Right now it's again bad. I think it's trading around 40. So that is into cold storage. So you need to store these vaccines and all in a cold storage. I don't know how much of this contract Snowman got. I'm not sure. I did not read about it. When you're looking at local factors, so when I'm making a direct investment, again I gave you that example, if an alcohol shops open up close to your residential investment, so it depends on how you treat it. Then interest rate, if interest rate is low, there'll be more demand for home loans, property prices will increase. Right now interest rates are low and that is why people are scared, because if inflation is rising globally, so therefore there is a problem that interest rates might be increased to tackle inflation. If interest rate increases, home loans become expensive, car loans become expensive, companies, it will be difficult for companies to raise capital at cheaper rates and all. So therefore economic activity comes to a standstill or it will be reduced. That is a risk that the government is facing. There is a trade-off between inflation, controlling inflation and promoting growth. Tell me, are you understanding this? Then there is your factors affecting the performance of real estate investment. Say suppose you hired managers and they are supposed to be managing your property. So whether they selected the correct property, have you selected the correct property? This Anil Ambani group did this, na? What was this? This amusement park, Bombay, make this huge amusement park. Come on, you guys don't read anything or what? Which was this amusement park? Yeah, very huge. Humongous. Near Bombay. Not SL World. SL World is long back. No, SL World Ambani. I'm talking about new Ambani one. Anil Ambani, I think. So park ka naam, I'm forgetting again. I forget the names and all. Anyway, so select. So which property, which real estate investment do I invest into? Should I open that amusement park or should I go into Bangalore and put up a Wonderla or do a cafe coffee day resort? So what kind of real estate investment should I do? So selecting, have you selected the correct real estate investment? Correct location, did you open your hotel, restaurant, office building, whatever? So selecting the property, financing the property, how did you manage your leverage, your loans, and raising loan at cheaper rates, and how did you do that? And how are you managing the property? Are you being able to generate good positive rental income? So nowadays we have more of IT parks and all, they're generating good rental income, but standalone office buildings are probably not doing that great. Lack of parking facility and everything. Tell me, are you following this? So how was the portfolio performance? How good is your manager in selecting the property, managing the property? What are the risks involved? Regulatory risk. What kind of regulatory risks are there? So I'll give you an example. There's this friend of mine, he has a very large land parcel, and the government has constructed a pipeline right from the middle of his land patch, and there is no construction allowed to be done around the pipeline for this much area. So obviously it creates a major problem, but you cannot do anything. There could be regulatory risk. This is not a very good example of regulatory risk, but this is also a risk of investing into real estate. There are a lot of zoning, so maybe you have declared a zone like around Delhi. There were factories and all around in the NCR region. Now Taj Mahal, there was this quadrilateral kuch tha na, Taj quadrilateral or something, and within that time, within that area, no factories are going to be allowed to pollute because the Taj Mahal was polluting and it was turning yellow or something. So permissions and all, environmental laws, etc. So that could be impacting your property and your property values and all. I think even there was some issue with this 42 that was being constructed in Kolkata, this building. Uska height ko leke. There was some issue with their height. So that is their manager's ability. So manager's ability to forecast economic changes. Can the manager estimate and understand what kind of economic changes can happen? Should I construct a mall over here or a warehouse over here, or should I buy this property over here? Like for example, earlier I used to think that, you know, we don't need so many 5 stars and all in Kolkata. But now I see everybody everywhere, it's occupied only. People don't stop having weddings. So anyway, so economic changes. So are you able to forecast that what kind of properties are required, what kind of construction is required? There are a lot of 3-star, 4-star kind of properties also which are doing very well in Kolkata. But there are a lot of different kinds of properties which will probably not be doing well, I'm not sure. So financial decisions, the kind of loan and all you took, the way you manage the property, is it going well? ITC is not generating profits in the hotel business. So you have to evaluate whether the manager's ability is there to create value and all. Leverage, how much loan can you take? Now when you're looking at investments into real estate sector, it is more of long-term investment. Say for example, you needed to take a short-term loan because of some opportunity. So you basically took a short-term loan, let's say a 2-year loan or a 3-year loan or a 2-year loan or a 3-year loan in order to get the property constructed and up and running. The property did not get constructed in 2 or 3 years, it took longer than that. Now you are going to start facing problems because of it. Right? And now after 2 years or 3 years, you need to again roll over your loan. So basically what happens is, at times companies are not able to take long-term loan. They take a short-term loan, they take another new loan and pay off the earlier short-term loan and roll over their loan. So you basically take a new loan, pay off the previous loan and continue with your loan. Let's take a better example. Suppose you, right now long-term interest rates are very high in the market. So it does not make sense to take a long-term loan right now. I'm better off taking a 3-year loan right now or a 2-year short-term loan. And then after 2 years, when I expect the interest rates to go down, maybe the interest rates are artificially very high right now. And I know that normally the interest rates are supposed to be in this range. So therefore in a couple of years, the interest rates will go down. So it does not make sense for me to take a 20-year loan or a 10-year loan at a very high rate. Instead, I'll take a short-term loan, and after a year or two, when the interest rates go down, I'll roll it over into a lower rate loan, a low interest cost loan. But what if after 2 years you were not able to raise money? Maybe the markets even worsened and there was less credit available in the market, there was less money available in the market. So ability to raise and roll over funds, that is a risk. Whether you will be able to raise money, whether you'll be able to roll over your loans, whether you'll be able to raise additional loan amount in order to run the property or expand the property or expand your real estate investment. So these risks are there when you're looking into real estate segment. Tell me, comfortable? This completes real estate.